Good morning and welcome to today's live technical analysis. Starting off once again with the euro against the dollar. It appears to have broken below our upwards moving trend line, broken below S1, so this could be support now turned resistance. For today, we're noting the speech by Fed Chair Powell, which is due to garner some attention for dollar traders. So the pound, the Japanese yen, and the euro may all be impacted by Fed Chair Powell's speech later on today during the American session. So let's just check our charts for now. This is support turn resistance. Switching this to red. Next target we had placed at the 1.0575 level, but that seems to be slightly too far away from the current price action. So what we could do, we could simply adjust our support level for S1, and then we could drop our S2 and S3 figures to lower ground in order to adjust for our new support level. So this is, as we said, support and resistance. Note that it might need some correcting. At this point, 1.0675 for R1. For S1, we could take this previous swing low as the next possible target for the bears. Now, interestingly, before we went live, ECB's lane comments could be perceived as slightly hawkish. And based on what the IMF just said, you could perhaps imply that the ECB may have some way to go before it has reached its terminal rate. But it appears that the markets may not be reacting to this news or may have found them as insignificant. I have personally not been able to see the entire speech, therefore I am unaware if he said anything else. It appears to be moving in a downwards fashion. RSI near 50 could have been a sideways moving fashion, but since it's broken below our support and resistance, we're maintaining a bearish outlook for the pair. So let's just fix up S1, 1.0620. Then for S2, we could either place it at the 1.053 level, but it'd be too far away from our S1. So what we'd ideally like to find is a midpoint, something that's not too far, but yet not too close. And the 1.0535 level, which we had said before may have been slightly too far, appears to be ideal in this scenario. Let me just bring these trend lines. As a matter of fact, let's just remove them, clear up our chart. So the distance between S1 and S2 is about 90 pips. So that's a bit ideal. In the mid range, it have been perhaps less important since we're taking though this swing low before it moved high and it's coinciding with our upwards moving trend line. This may be a significant support level. For S3, we'd have to readjust, and we're actually going to be bringing it down here. Numerous blocks before it moved higher, so found heavy support at this point in time. So 1.0460 for S3. So you have R1, R2, R3, and actually R2 could be brought slightly lower, coinciding with the closing of this bullish candle, the opening of this bearish candle, and validated by this wick of this bearish candle. 1.0747 for R2, and as a matter of fact, we could bring R3 slightly lower. Let's measure the distance between R2 and R3, 90 pips as well. So why am I using this instead of this? Well, this could also be a valid point. It's slightly too far away, so 120 pips is unlikely to occur within today's trading session. Perhaps within the next few days, that may be possible, but for now, we're maintaining more of a shorter term outlook. So I placed it on this point where it found some support, moved higher, but failed to maintain the support level, broke below, and as such, has turned to resistance. 1.0837. We're going to be removing our previous resistance of R3. So we have R1 R2 and R3, S1, S2, and S3. We're maintaining a bearish outlook for the pair. Breaking below may imply a switch. Could also be a sideways fashion, but since it's broken below and opened lower than the closing of this bearish candle, maintaining a bearish outlook for this pair. As a matter of fact, we could perhaps see the beginning of a downwards moving trend line, but not from that bullish candle, instead from this bearish one, moving to lower ground, continues to validate, aiming for S1. Perhaps after breaking S1, may remain in a sideways fashion, but next target could be S2. Finally, S3 1.046. If it breaks above our upwards moving trend line, I would switch from a bearish to a neutral market sentiment, so remaining between R1 and R2, which would be resistance turn support. For a bullish outlook, it would need to break above R2. Why? As we said, RSI near 50. So if it does break back up, it would need to break above R2 for a bullish outlook to occur. So we're maintaining, for now, a bearish outlook based on what we've said. The dollar against the pound appears to be imitating the euro. Excuse me. The pound against the dollar appears to be imitating the euro against the dollar. So cable moving lower below S1. Once again, support and resistance, new R1. Next potential target could be R2. Excuse me, S2, which is now S1. And as we've done before, perhaps placing our first level of support slightly closer, 1.2180 for S1. And then bring it slightly lower, 1.20635. 1.2065, just rounding it up. Taking these candles here. And why are we moving S2? Well, based on the price action, it may be more prudent to bring or establish new support and resistance levels. It does not mean that this is not valid as a support level. It just means, in my opinion, that this may be more of a temporary support level, whereas this may be more of a stronger support level based on the price action that we are seeing currently. So 1.2090, I think we had said. Yes, coinciding with this high, taking these blocks into consideration, fairly narrow, breaking below S1. Now, the difference between the pound and the euro, as you can see, is that the RSI indicator is 43 for cable and 46. So it appears to be moving slightly lower and faster, I'd say, than the euro. So the euro, well, so this is why we're also maintaining a bearish outlook for cable as well, breaking below support trend resistance, in addition to breaking below our upwards moving trend line and the mid-range of the Bollinger Bands, all imply towards a bearish market sentiment, aiming for S1, 1.2190, S2, 1.2065, and then lastly, S3, 1.1925. Dollar against the Japanese yen. We had stated yesterday that this upwards moving trend line may have been far too steep. It appears to have been broken, but the pair appears to continue moving in an upwards fashion. So we could simply readjust our upwards moving trend line based on the new data that we have. For support and resistance, now if you're narrowing your chart, then it might make sense. But if you're widening it slightly higher, this actually might be more of a prudent level. As you can see, it's coincided nicely with this bearish candle, tested support and moved higher, validated by two candles, a third, and a fourth, and the fifth as well. I take more complete blocks as a sign of greater support or resistance, respectively, which is why, if you were looking, I immediately looked at this point, at this level here, this bullish candle, then this bearish candle, which moved significantly lower, before actually testing if it validated this bearish and bullish candle. So this, for me, is a valid support level, 150.30 for S1. Then for S2, we could be keeping our prior level of 148.87. For S3, 147.40. Now, in this case, even though we moved S1 higher, we're not moving S2. Actually, I stand corrected. Slightly higher to the swing low. bit more prudent, 149, 149.02. Yes, we're moving slightly higher. And then for S3, we could keep it that point. Why? We're expecting government intervention potentially at R1, as we had placed previously, perhaps moving lower. The RSI has broken above 50, bounced off 50, and is moving towards 70, implying a bullish market sentiment. Therefore, the potential target for the bulls might be R1, 151.65, aiming then for R2, 153. Although I do not personally believe it will reach R2, it is still a potential resistance level, and as such, we are noting it. R2 and then R355. For a bearish outlook, breaking below S1 and moving towards and testing S2, simply breaking below. Perhaps, yes, simply breaking below S1 with the breaking of our upwards moving trend line could coincide for a switch to a bearish outlook if the RSI drops below 50 as well. Next target 149.02. Lastly, 147.4 for S3. The Aussie appears to have found resistance, 0.6154, broke lower. Now it's still between S1 and R1. The narrowing of the Bollinger Bands in this case, in addition to it running along the figure of 50, would coincide for a neutral outlook. So when we say neutral, we mean sideways between S1 and R1. As long as it stays between these bounds, we would maintain a sideways bias for this pair. Despite us having an upwards moving trend line, does not mean it is a bullish. Perhaps from a more macro perspective, you may hold a bullish outlook for the Aussie, but for now, sideways, and I think this might actually be broken within the next day or so. So sideways bias between S1 and R1 for the Aussie. If it switches to a bullish outlook, we would require a clear break above R1, moving towards R2. Next target R3. For a bearish outlook, breaking simply below S1, which would coincide with the breaking below our upwards moving trend line, and then towards S2. Next target potentially being S3. We're going to be looking at some stocks as well today, but before we reach that level, we're going to be looking at gold. Moved in a sideways fashion, broke below, sort of regained with this bullish candle, perhaps taking out some stops, and continuing its downward trajectory. Now, based on the fact that there's been numerous talks about a potential ceasefire in Israel, we may be seeing pressures on the precious metal easing, which may allow gold to move towards S1 1945, with the next potential target being 1915. Given that the RSI is near the reading of 30, as a matter of fact 33, we're maintaining a bearish outlook for the precious metal. Despite this bullish candle, it's still below the mid-range of the Bollinger Bands, broke below support and resistance, aiming now potentially for S1 1945 or 1946 would coincide beautifully with these bullish and bearish candles as well. So simply readjusting. Next target 1946 for S1. Next 1915. Lastly for S3 1880. We're going to be looking at oil as well. Oil broke below our support level we had placed yesterday at 78.15. One could even say it's beginning to form a downwards moving trend line, broken below the mid-range, following the lower range of the Bollinger Bands, RSI below 30, 23. Now, if it continues to move, the RSI moves below 20, it may be oversold and maybe due a market correction to higher ground. Therefore, we'd be keeping an eye out on the RSI indicator. But from a technical basis, given that it's still near 30 and below 30, it appears to be a strong bearish market sentiment, in addition to having broken below our support turned resistance level. But we're going to be removing that as we see that it's clearly moved below. So S1 75, S2 70.6, and now we're going to be looking for S3. The reason as to why we've removed RS1, which we had before, and not simply switched it to a resistance level, is due to the price action that has steadily moved lower, whereas in comparison, the euro appears to have found some support, moved and then broken below, in addition to the pound as well. Moved slightly lower, it appears to have rebounded, then came back down. But for oil, it appears to be continuing a downward trajectory. So we're not going to be placing, we would not be switching our support and resistance. Simply put, S2 becomes S1, S3 becomes S2, and now we're going to be looking for support level at S3. For S3, this could be a potential target. The difference about two something dollars, but that is 5, so it's too close to S2. Whereas at 68.3, 66.17. Let's see if 15 is still validated. 66.15, much more optimal. So had I placed support here, let's just change the color so that's easier for you guys to follow along. Too much of a difference between S2 and S3. Had I placed it here, perhaps still valid, but the difference between S1 and S2, this would be slightly closer. But with S3 currently at 66.15, which is coinciding with the opening of this bearish candle, the closing of this bearish candle, the opening of this, the closing of this bullish candle, and the opening of this bullish candle as well, seems to be validating my theory of a support level at that point. Therefore, 66.15 would be target for S3. Current target for the bears, 75, which is also a big figure, significant if it breaks below, perhaps coming back up to the test before moving towards 70.6. RSI below 30, applying strong bearish market sentiment. Therefore, we're maintaining a bearish outlook on crude oil. In addition to the API weekly crude oil inventory, which came at 11 million, if I'm not mistaken, implies reduced demand for oil, perhaps pushing prices lower as well. So now I'm going to be looking at a few stocks. In particular, we're going to be looking at UBS. We could look at Goldman Sachs as well, but I'd like also to look at UBS, Tesla, and perhaps even Commerzbank. So starting off with UBS, who posted its earnings yesterday. Now, UBS's earnings came in lower than expected in terms of revenue. Approximately, they had a loss of 735 million US dollars, but it appears that the stock has moved higher. Why? Well, based on their earnings call, the company has regained 22 billion US dollars from former Credit Suisse investors in their wealth management group. So essentially, they've recouped the money that was taken away from Credit Suisse during the time period upon which Credit Suisse declared bankruptcy. Therefore, given that you're bringing back in money, so your business plan appears to be working in terms of how to retain and perhaps bring back the old money, and in particular, 22 billion is a significant figure. It appears that the potential loss, excuse me, not the potential loss, the loss that was incurred in terms of cost for integrating Credit Suisse into UBS appears to have been minimized by the better than expected client retention levels and new money that's been flowing into the bank. Therefore, it appears to have jumped. You can see moving higher. So based on that, we're maintaining a bullish outlook for the bank. This may be a gap that might be filled at a later point in time. So we have S1, S2, and S3. We could even, we're going to be keeping our support and resistance levels. Let's drop down to the 1 hour upwards trajectory as well. Bullish candles, a slight bearish candle, maybe testing support before moving higher, or even actually coming back to this liquidity gap that was formed. So in order for a bearish outlook to occur, it would need to break below S2 as well. Simply breaking below S1 would not cut it. Why? There's a gap that might be filled. So if it wicks down to this gap that we had placed and then moves back up, we're still maintaining a bullish outlook for the bank's price. So you have, let's just fix these text labels. 24.65. We could even actually bring it 24.30, 24.40, just to incorporate that gap. So for now, based on the new support level, bearish outlook breaking below S1, bearish outlook continuing its upward trajectory and breaking above R1, 24.13. Fixing S1, S2, S3, and then R1, R2, and lastly R3. So bullish outlook on UBS based on the earnings transcript that was released yesterday. Tesla for our chart. Let's remove the grid. Nice. So Tesla has apparently given a 4% wage increase to their production workers in their gigafactory in Berlin. Now, from a more macro perspective, these increases could weigh on Tesla's bottom line. Why? Higher cost of labor could impact your profitability or profits, therefore potentially weighing on the company's stock price. Let's add a few indicators as well. ATR, trend, Bollinger Bands, levels 50, 20, and 70, dark blue, upper range. Let's see what else we could add. Could add the RSI. RSI near 50, broken above, upper range, sideways fashion for the company's stock price. But let's just make sure that from a technical basis that is also validated. I'm going to take, because there is a gap as well. Now let's see if this gap was actually filled. Nope. Hasn't been re-verified yet. Maybe an interesting point to keep an eye on. Let's remove the rectangle. So we could place S1, then S2 lower, gap that might be filled, but based on the price action, there appears to be a support level at this point, so that would be S1. For a bearish outlook, we would need to break below S1 and S2. For R1, 234.20. I'm looking at this point, which is coinciding with this bearish and bullish candle. Validated as well, broke below, moved lower, fluctuated around, broke above finally, and then moved higher. Came back down, found support, then jumped below. So potential resistance level in the future. So that would be R1. And then for R2, 254.25. And then for R3, taking this order block here, 271.40. Strong downward trajectory after moving slightly higher, found resistance, moved lower. And then we'd need to find S3. So for S3, taking this previous high, it broke above and then moved higher, 175.60 for S3. So now that we have our support and resistance levels, on the other side is near 50. It reached the upper end of the Bollinger Bands and is now slightly moving lower. So I'd maintain a sideways bias for the company's stock price between S1 and R1 on a short-term time frame. So perhaps moving between S1 and R1 for a bearish outlook, breaking below S1, aiming for S2. And then for a bullish outlook, breaking above R1 and then potentially moving towards R2. But for now, perhaps a sideways fashion between S1 and R1. We've done UBS, we've done Tesla, we could do Commerce Bank. If I'm not mistaken, the bank reported that the revenue actually grew by 3x. So that could be the initial reaction. So upon the release of the bank's earnings, this is probably it. Jumped above and then market correction and has now taken everyone that was long. So is this a market correction or is there something that we have not seen? It actually took out everyone here as well. Given that I have not seen the bank's earnings in full, I've only seen what was the headline, which was X3 for revenue. This may be something that was reported after we went live or that was seen. Let's just add a few indicators as well. Bollinger Bands. Insert indicators and we can go to the RSI. Let's just make this perhaps a darker blue. Bearish full for the German bank. Now, based on a technical basis and without any fundamentals, this would be my S1. Technical is full. Bearish and bullish candle validated by a wick. Recent price action validating this as a support level. Aiming for S1, 9.85. I would be S1, then for S2. Given on this big move, but it may ease. So what do I mean by ease? You're seeing this as an initial reaction based on the earnings. Once they came out, jumped up, perhaps taken out everyone. If it moves higher, it depends on what they've said during their earnings call. And then this could be a secondary reaction from the 4 hour. You can see it moving in downwards fashion, but if you move to the 1 hour, move higher, then moving lower. Is a significant move compared to the previous trading ranges. You can see huge. Taken out this anyone that was short, gone. Anyone that was long from this point onwards, gone as well by this wick and did not have their stop loss below. So this could be 9.45 for S2. Perhaps moves in smaller candles, but we'll see. And then 9.08 potentially for S3. But based on how big that movement was, maybe it's prudent to readjust. I'm taking this bullish and then Bearish candle validated support, moved higher. Now, the reason as to why my S3 is further away than S1 is from S2, this actually might be too far away. But I want to give it some more space due to the fact that this move has occurred. Perhaps we could bring it slightly closer, but not too close, 90.05. So you have S1, S2, and S3. Resistance. Now, we'll place R1. Came back lower. Broken below. But if it does come back up in a different candle, it may meet resistance at this point. R2, taken by this wick purely. Haven't even seen what's before. Okay. Ignoring this as this was taken out. So R1, R2, 11.05. And actually 7.04. And then for R3, we could place it perhaps it's too close to R2. Taking the strong bearish candle before it moved lower. 11.35. So based on what we're seeing now, RSI, let's drop down to the 1 hour time frame, 30-minute, 15-minute as well. Strong bearish market sentiment, moving lower, perhaps aiming for S1 before creating a swing low and then perhaps moving in a slightly sideways fashion. But based on what we're seeing on a technical basis, bearish outlook breaking below S1, aiming potentially for S2 for a bearish outlook, whereas for a sideways fashion, remaining in between S1 and R1. I am well aware that compared to the previous trading range, S1 and R1 are significantly distanced apart. So there is a big area that could easily be construed as a sideways fashion. So it's like I'm taking this with this. But based on this candle and its price action that it created within the past 4 hours, it is more prudent to give it some space, and then we can come back and readjust our support and resistance levels. As you can see, strong bearish market sentiment. Look at this 1 hour bearish candle. It's aiming for S1. If it breaks below, potentially moving towards S2. If not, also S3. For a bullish outlook, breaking simply above R1, aiming for R2, not breaking it as well. Next target potentially being R3, 11.35. But for now, we're maintaining a bearish outlook on the bank. Let's also look at a few more. Before we finish today, we can circle back and test and see how it's doing. At Lockheed, Alibaba, Intel, BNP Paribas, Amazon, Ford, UBS, Tesla, Travelers. Let's look at the S&P 500. Let's move on the 4 hour. Actually has met resistance at R1, 4,385 as we had placed. So testing and validating our resistance level. S1, 4,260. Bullish outlook for the S&P 500. And we could readjust S1. Now, as I've said on numerous occasions, I'd like to take a few candles in terms of their opening and closing figures in order to establish a support or resistance level. And I was looking at these two candles with this strong bearish order, with this strong bearish candle, And looking back, you can see numerous candles here. Found support and moved higher, found resistance, finally broke above, and then moved in an upwards direction. So this could be a temporary support level for 1290.50, keeping S2 at lower ground. But we could readjust it slightly higher. I'd rather keep it as we had it before. Why? Because I've brought in this far too close to R1, so to the current price action. So if it does break below, I'd like to have it some providing more distance between S1 and S2, because if I place it around here and it broke above below S1, could easily break below S2, and then S3 could then be broken. Whereas S1, S2, and then S3 for R1, currently 4,385, R2, 4,510, then for R3, 4,628. Then for the Dow Jones 30, it's broken above S1, as we had before. Aiming for R1, maintain a bullish outlook as well. RSI is near 70, implying a bullish market sentiment. I'm expecting the Nasdaq as well. The Nasdaq actually broke above our resistance level. The RSI for the Nasdaq and the RSI for the S&P 500 and Dow Jones 30 do not coincide. The RSI is above 70, 74, no, 75, which implies a strong bullish market sentiment, whereas the Dow Jones 30 and the S&P 500 are still around 60. So there appears to be more of a stronger bullish market sentiment in tech rather than industrials and financials. It's broken above our R1. As we had said yesterday, this was far too close anyways. But interestingly, it came back slightly higher. For support, perhaps we can keep 15,120. Try it not support, resistance to support. Given the way it's moving, perhaps it'd be more prudent to bring lower R1, keep S1 based on the price action. And the way we could do that is it's far too close again. 15,465. Then for R2, 15,795. We're keeping R2. And then for R3, we're seeing the 2 wicks of this bullish and bearish candle. There's probably a small bullish candle here. And I was looking at this point where you saw significant resistance. When it finally broke above, it moved higher, came back down below. Let's just check. Yes, there was a bullish candle before, but validated here. Perhaps let's see. Valid resistance as well, but compared 16,175. Let's just go back and I'll explain why. So we're trying to be keeping the same distance apart between support and resistance levels as well, although for support it appears to be a bit closer than the resistance levels. So this chart could be used for a more macro time frame. 14,720. So you have S1, S2, and S3, similar to R1, R2, and R3. And based on that, let's just go back and I'll explain why. All right. So came back down, bearish candle, found support, bullish, broke above. So a wick validating this as support, then strong, and then this bearish candle poked below, strong bearish candle, then continued moving in a downwards fashion. So support closely coinciding with these bullish and bearish candles. So there was prior resistance here, hasn't been tested as well. So potential resistance for R3 in terms of, and you could see an upwards moving trend line. It's a bit steep and it's about to be broken as well. So this could also be an indication of it moving slightly in a sideways fashion between S1 and S2, S1 and R1. But based on the RSI, we're maintaining a bullish outlook for the Nasdaq. I'm going to avoid placing an upwards moving trend line for now. But if it does come back down to S1, we may see it move in a sideways fashion. So I'll be placing this trend line. We only have one point of correction, validating our upwards moving trend line. I'd rather have like 2 or even 3. And this is actually a much more nice upwards moving trend line. So if it breaks below, actually, let me just explain as well. So I have 2 trend lines, starting from here and then starting from S3 and then starting from S2. This, I think, is more valid than this. Why? I have 1 and 2 points of validation of an upwards moving trend line, whereas from S3, I only have 1. Therefore, more touches equals a greater degree of validation as such. If it breaks below our upwards moving trend line, switching from a bullish to a neutral bias between S1 and R1, whereas if it continues and does not break below, and RSI remains above 70, well, close to 70, breaking above R1, potentially aiming for R2. And for a bearish outlook, breaking below S1, with the next potential target being S2 at the 4,720. And with that, I think that does it for today. Thank you for watching.
My name is Emily and welcome to another educational video. As part of our technical analysis series, we would like to look at the technical indicator called moving average. A moving average displays the average of data points across a predetermined number of time periods, typically price data. Because each data point is computed using information from X number of prior time periods, it is referred to as a moving average. Moving averages smooth the price data to create a trend tracking indicator by averaging previous data. Although they lag since they are dependent on historical values, they determine the current direction of the price rather than predicting it. Moving averages help smooth out fluctuations in market prices, filtering out the noise and making it easier to establish underlying trends. They also serve to alert traders to important changes in direction. Moving averages can be used to indicate potential support and resistance level, as well as the trend's direction. Additionally, they serve as the foundation for additional technical overlays and indicators, including Bollinger Bands, MACD, and the McClellan Oscillator. The most popular is the simple moving average. By calculating the average price of a security over a predetermined number of periods, a simple moving average is created. For a 5-day moving average, you simply add the closing prices of the last 5 closings and divide this sum by 5. You add each new closing and skip the oldest. A moving average is an average that moves as its name suggests. The average moves along the time scale as new data is added and old data is deleted. The method is the same whether you choose a 10-day average or a 40-week average. Rather than adding 5 days, you add 10 days or 40 weeks and divide the amount by 10 or 40 as appropriate. Thank you so much for watching us today, guys.
Okay, never mind, let's go ahead and get started. So today's webinar will be on martingale strategy. Okay, I personally don't use this super often. This is more of a way of strategy to cut down on your losses, but we'll just go through them, just go through a couple of strategies and how you can incorporate them into your trading strategy right now. Okay, so as per usual, just a risk warning. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So the material in this webinar is just a personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Okay, redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your speaker for today. So I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll just go through a brief intro on what exactly martingale strategy is, and then how it works, the pros and the cons of the strategy, and some trade management if you intend to use martingale. Okay, so let's get started. So the martingale was introduced by French mathematician Paul-Pierre Lévy and became popular in the 18th century. So the martingale was originally a type of betting style based on the premise of doubling down. However, the American mathematician Joseph Leo Doob continued to work on the martingale strategy, but he sought to disprove the possibility of a 100% profitable betting strategy. So the martingale strategy is kind of like a betting strategy and not so much of a technical analysis strategy. Okay, it's more of like betting and gambling or like roulette kind of strategy. So the system's mechanics basically involve an initial bet that is doubled each time the bet becomes a loser. So given enough time, one winning trade will make up for all of the previous losses. So that's why I mentioned a roulette wheel, because if you think about the zero and the double zeros on a roulette wheel, which was then introduced to break the martingale's mechanics by giving the game more possible outcomes. So that made the long run expected profit from using a martingale strategy in roulette negative, and thus discouraged players from using it. Okay, so what exactly is it? When you use a trading strategy that is anticipating a market move, chances are that you might be wrong or right. But most of the time you can't tell, right? So as you know, the markets are irrational. Therefore, there are times when you are right on the money, but there are also times when the markets will prove you wrong. And that's why the martingale strategy is based on the theory of increasing amounts, even if the value is falling in expectation of a future increase. So it's based on the idea of averaging down in order to avoid losses rather than seeking profits. And it's also an extremely risky way of investing or trading, since you are just betting, basically. Okay, let me know in the chat if there are any of you guys who actually regularly use the martingale strategy. I'm just curious to know. Because it is a very popular strategy, although very, very risky. Okay, let's move on. So here's an example of the martingale strategy. So you can imagine it's basically coin flipping. So suppose you engage in a game of either heads or tails with a starting wager of $1. So there's an equal probability of it being heads or tails. So if you lose, you would double the wager on the next bet in order to essentially cover your losses. As long as you stick with the same call, you would eventually given an infinite amount of money, you would eventually see the coin land in your favor. And it will also recoup all of your losses plus an additional dollar. So the way of visualizing this is to basically understand the basics or the underlying theory of the martingale strategy. So if we're talking about the example that I just gave about coin flipping, if we look at the first column, which is the lose column, let's say you are betting one coin or $1, right? And then you lose. So essentially the strategy encourages you to double the amount that you are betting. So in this case, it will be $2. And then if you happen to lose again, then you double it again and you get $4 and you're betting $4. And then if you lose again and you bet double the amount, that's how much you are winning. If of course it lands in your favor. So what we mean by recoup your losses plus an additional dollar, you can see here we are losing 1, 2, 3, 4, 5, 6, 7. We're losing $7 in our initial rounds. But since we doubled each round, our ultimate winning stage or our profit is essentially an additional dollar here. Okay, so the strategy is basically is based on the premise that only one trade is needed to turn your account around. Okay, so if we're taking a look at a chart and we apply the same concept to our trading charts, right? You can see here, if we ignore all of this, we start off at this first buy one lot area. Okay, so we buy one lot and then we see price continue to drop. Okay, so we can see that we're obviously going to make losses since price is moving in the opposite direction, right? So price is dropping, I'm losing money, but instead of cutting my losses or getting out of the trade, right, I decide to buy 2 lots instead. So I'm doubling it using the same concept of the coin flipping strategy in my previous example. I'm doubling my lots here. I buy 2 lots, and I can see even though price did increase by a little bit, it reversed and it ultimately continued to drop. So I'm actually losing 3 lots now. Okay, so I'm losing some more money, and then instead of getting out the trade again, I'm buying 4 lots. So you can see it's a very risky trading strategy, and um yeah, I probably would not recommend it unless you're trying to cut your losses. But yeah, this is basically how it works. So we buy 4 lots, right? And you can see price did increase a little bit, okay? And then it dropped again. So now that it dropped, um, going by the same martingale strategy, I will double it again, buy 8 lots, continues to drop. So I've essentially lost all of these lots, okay? Which is a huge loss if you think about it. And then once I reach the bottom here, I decide, okay, I'm gonna double it again. I'm gonna continue with my martingale strategy, right? So I buy another 16 lots here. But instead of continuing to drop, my luck changes and the chart decides to reverse off and it's heading upwards again. So now that it's heading upwards, I can imagine that now that I have 16 lots, I'm making back all of these losses. Okay, and I can see that it's really increasing, it drops and it continues to increase from this support level here at the 0.98803 level. Okay, so it bounced off this support level and it continues to rise up, enabling me to make back all of my losses as well as a little bit of profit. So that's essentially the theory behind martingale. Okay. Let me know if you guys have any questions. Okay, so it's a popular strategy, as I mentioned earlier. And one of the reasons why it's really popular in currency market, so like Forex, is that currencies, unlike stocks, rarely drop to zero. So although companies can easily go bankrupt, most countries would only do so by choice. So there will be times when a currency falls in value, but even in cases of a sharp decline, the currency's value rarely reaches zero. So the FX market, another advantage that it offers is that it makes it more attractive for traders who have the capital to follow the martingale strategy. So the ability to earn interest allows traders to offset a portion of their losses with interest income. So that means that an astute martingale trader may want to use the strategy on currency pairs in the direction of positive carry. So in other words, they would borrow using a low interest rate currency and buy a currency with a higher interest rate. Okay, but as we mentioned earlier, for this method to work, the underlying assumption is that you have an infinite capital, which in most cases is unrealistic. Okay, because the money in your pocket is always going to be less than the chance that the next operation is a loser or the price goes against you. Okay, so let's take a look at another example here. So you can see price is moving upwards at the start, right? So at this resistance, I decide to buy 1 lot because I expect that price is going to continue in this increasing trend. But instead of continuing, it reverses off of my resistance at 1.12417. So it reverses and then it hits down. At this swing low, I decide to buy 2 lots. Okay, so it goes up and I do make back some of my losses. However, it reverses back down again. And it reverses up, and at this swing high, I buy another lot. Okay, so essentially for every lot that I lose, I'm doubling it, okay, to earn back what I lost earlier. and then restart that. Okay, so over here, once I've made back my losses, here I'm buying once again, buy one lot, but instead of increasing, it drops again. So now it drops again, I'm buying 2 lots, I'm doubling it, it increases just as I expected, I make back my losses, and then it drops again. So it's the same kind of concept. Lastly, price increases, I buy 1 lot, it drops, and I buy 2 lots. And you can see it really increases, really moves upwards. So I really am earning back my losses as well as a little bit of profit. Okay, but of course, you wouldn't know whether price is going to continue to go up or it's going to reverse, which is why it's an entirely based on luck and bets. Okay, the reverse martingale, okay, is basically looking at 0.5 lots. So instead of doubling it, in this case, we are dividing by 2, okay, or looking at a factor of 2. So here at my first swing low, we have buy 1 lot. So I expect it to go up, I make that profit, and then I buy another 0.5 lot. Okay, because I didn't make any losses. Price moved upwards just as I expected. So I buy 0.5 lot and moves upwards just as I expected, and I buy another 0.125 and it rises, and buy another 0.06 and it rises. Okay, so this is the anti-martingale strategy, which I personally don't use, but you can let me know in the chat if you use this and you think that it's useful. Okay, so from this trade, we've made 750 pips just from 3 trades. Okay, so we only needed 1 trade to break even. Okay, so here are some limitations of using the martingale strategy. So when you use a trading system that is anticipating a market move, chances are that you might be wrong or right. So there's equal probability. But you cannot be right all the time because you know that markets are irrational. So therefore, there are times when you are right on the money, but there are times that markets will prove you wrong. So there are a couple of important considerations for you to take note of. Okay, firstly, the amount invested can reach huge proportions after a few transactions, since we are constantly increasing our lot size or constantly doubling our lot size. So if the trader runs out of funds and exits the trade, the losses faced can be disastrous. Yeah, you've used it before. Almost had a heart attack looking at equity. Yeah, so it's purely a betting game. But it's quite, I guess for scalpers, they tend to prefer to use this in order to curb their losses. So yeah, to each their own, but it's just keep in mind that it's very risky. So the risk to reward ratio is also not reasonable. Higher amounts are spent with every loss until a win, again because you are doubling your lot size, and the final profit is only equal to the initial bet size. So what this means is that your initial bet size, which is typically 1 lot, your final profit, since you have made so many losses before your final profit, your final profit will not be a significant amount. Okay, so some important considerations. The martingale strategy assumes that you have an infinite amount of capital. So we mentioned this earlier. And in reality, and it also assumes that markets will eventually reverse and it will be in your favor. But in reality, both of these assumptions are incorrect. So the forex markets can trend for extended periods, resulting in a series of losing trades that can quickly wipe out your trading account. So the strategy can lead to large drawdowns and may not be suitable for traders with limited capital or those who cannot withstand substantial losses. So, if you are thinking of using the martingale strategy, proper risk management and stop loss orders are critical when using the strategy in order to prevent catastrophic losses. Okay, so I'm just gonna quickly go through a couple of risk management or trade management strategies that you can implement if you are considering using the martingale strategy, just to prevent losses. Yeah, but actually these trading strategies or trade management strategies are useful even if you're not using the martingale strategy, even if you are just using technical analysis. It's always important to make sure that you pay attention to your trade management. Okay, so if you were here for our trade management series, some of these slides will be familiar. Okay, but I'll just quickly go through them. So firstly, we have trade management with confluence. So this is super important for um, any kind of trade. Okay, even if you're not using martingale strategy, this is still important. So stop loss is typically placed beyond a confluence area. Okay, so if you're wondering what exactly is a confluence area, it's basically where there are different support and resistance levels that match up with Fibonacci or your moving average, all of these signals. If they tell you that one specific area is important after using several different indicators, that is what we call a confluence area. Because price has tested that level many times before, so it's likely to test that level again since price is attracted to strong areas of confluence. Okay? So for stop loss, we typically would recommend you to place it beyond a key confluence area because price is attracted to these areas. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse. Okay, so if we take a look at the chart that I've included below, let's take a look at our stop loss first. Okay, so we're going in this example for a buy entry. So we're expecting prices to move upwards, right? But in this case, price is moving downwards. So we've placed our stop loss below or beyond this Fibonacci confluence area. And then now let's take a look at our take profit. So your take profit, we would recommend you to place it before a key confluence area because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it actually reverses back to your entry, or even worse, your stop loss. So that's one of the reasons why people complain that there is market manipulation because they miss that take profit by 1 or 2 pips. Okay, so let's take a look at the diagram again. In this case, my take profit is placed above since I'm going in for a buy. Okay, and instead of placing it beyond it, which is like what we did for our stop loss, I'm placing it before it in order to make sure that I catch the price before it reverses off of the confluence area. Okay? Okay, here is another example. In this case, we are going in for a sell, which is why our take profit is below, or rather it is at our support level. Okay, so this is actually support area, not resistance. Yeah, so we're going in for a sell, and instead of placing my take profit beyond it, like what we saw in our previous example for stop loss, now I'm placing it before it. As for our stop loss, I'm placing it beyond my major resistance area or confluence area in order to make sure that I don't get stopped out before price reverses. Okay. Okay, let me know if there are any questions so far. Okay, but if not, let's continue. So let's take a look at another example. So in this example, we expect price to bounce off of our entry at 87.625. So this blue line here. And this line is a pullback resistance. So what we mean by pullback is when we have a swing low and price bounces off that swing low and swing low support, it bounces off it and it reverses and breaks out of the support. That's what we call a pullback resistance because we are expecting price to pull back to that same level. Okay, so this pullback level is in line with a 78.6% Fibonacci retracement. So you can see my starting point here and ending point here. Okay, so it's in line. So that's what we call a confluence area. Okay, so we're expecting price to continue to drop from our entry. Okay. So you can see price has hit our entry and has reversed nicely off of it and is heading towards our take profit. Now, if we take a look here, I have a Fibonacci projection. So this is wrong. It should be 78.6% Fibonacci projection. Okay, so my starting point is here, middle point and ending point. So for Fibonacci projection, we're looking for this flash shape here, like a lightning bolt kind of shape. Okay, and my 78.6% lines up with my take profit. Okay, and the reason why we placed our take profit at this swing low is also because, of course, this is a significant level since it's a swing low support. Okay, so instead, you can see here, instead of placing it before, I did place it slightly before, but instead of placing it beyond it, place it slightly before, and I can see price just touched our take profit before reversing off of it. Okay, so I was able to catch that price, or you can see it's very, very close. So I was able to catch it before it reversed off. Okay, and luckily I did because after that it reversed off of the take profit and rose steadily to our stop loss. So can you imagine if I placed my take profit below instead of above our confluence area, I would have missed it and I would have been stopped out. Okay, so similarly, if we're taking a look at let me go back. Okay, if I'm applying it to maybe over here, our martingale strategy. Okay, my entry point would probably be here, right? If I'm going in for buy. Okay, and then my stop loss would probably be somewhere up here since my previous price has reached this resistance level. So my stop loss would probably be beyond it in order to make sure that I don't get stopped out in case of price breaks out. Okay. Oh, actually, if I'm going in for a buy, I will place my take profit on top. Okay, and my stop losses will be below. Okay, since obviously I'm going in for a buy. But in this case, because we are using the martingale strategy, you don't want to be stopped out. Like no matter what, you don't want to be stopped out. Okay, so if we take a look here, okay, this is kind of a bad example, but we would try and find an area where we can expect price, okay, maybe over here. I don't know if you guys can see my mouse, but you can see price kind of has this overlap support level here because we have kind of a swing high here and a swing low here. okay, that line up in the same level. So I'll probably want to place my stop loss beyond this area, so just under here, okay, just to make sure that in case price reverses off, I wouldn't get stopped out, or I would get stopped out, but with minimal losses. Okay, but luckily in this case, we see price continue to move upwards, and we earn back our losses from our first entry. Okay, so that's what I mean by trade management is super important if you're using the martingale strategy. In this case here, let's take a look at the buy one lot. Okay, your take profit will probably be maybe here at this swing high here, and then my stop loss would probably be just under here. Okay, so if I'm going in for a buy here, okay, I can see price didn't increase at all. In fact, it reversed and it hit it down, but we didn't get stopped out because our stop loss is beyond this swing low support level. So we place it below it or beyond it, then we're not stopped out, and then we earn back our losses again. Okay, I hope I explained that clearly. But yeah, I just wanted to give you guys an example of how you can use this for martingale. Okay, here's another example with a couple more Fibonacci levels. Okay, so our second example looks at the Kiwi and Japanese yen. So price looks like it's dropping, right? We have this descending trend line, but price recently broke out of it. So that's a sign that price is, or rather a reversal in trend. That's a sign of a reversal in trend. So our entry is placed here at this swing low, or rather this overlap resistance. Okay, because overlap, because it basically means that there are bulls and bears that are respecting that area. So we have swing lows and swing highs that line up in the same level. Okay, so we're going in for buy entry. Okay, going in for a buy entry towards this take profit. So how do we know this, where to put our take profit in this case? Because we make use of our Fibonacci levels. Okay, here you can see we actually have three different types of Fibonacci. So we have the minus 27.2% Fibonacci expansion, the 127.2% Fibonacci extension, as well as the 78.6% Fibonacci projection. Okay, so we have all of those levels that line up in this area here, and that's why we decide to put our take profit here. Okay, so here's what happened. Since we place our take profit beyond the confluence area, okay, above it or beyond it, instead of before it, as we mentioned earlier, okay, instead we placed it beyond it, and so price reversed off of our confluence area, and we missed our take profit by very few pips. So instead, what we should have done is to put our take profit below, just below it, and price hits our take profit nicely before reversing back down to our entry. Okay. Next, let's take a look at break even. So this is kind of the entire concept of martingale strategy. It's basically to allow you to reduce your losses and just break even. Maybe not even take a look at the profit, since profits are about the same value as your initial amount. Okay, so break even is basically a level where you are in profit and recognize that there is a risk of reversal, which means that price is likely to hit back to your entry. So the level is basically you saying, if I'm right, then price should go all the way to my target. But if it goes back to my entry, then I'm wrong and I should get out ASAP. Okay, so firstly, we have our entry. In this example, we have our entry at this double swing high resistance. okay? And then price kind of fluctuates in between, and it hits this level. It hits this level here, and it reverses and it continues upwards. Okay, so it continues upwards towards our take profit. So our take profit is at this green area here. So it's continuing, but it actually reverses. So now that I see it reverse, I quickly go in and at my break-even level here. Okay, this is where my break-even is at, this swing high resistance, and my break-even is triggered at this level. Okay, so I see price continue upwards, reverse down, and hit my break-even. And then what I'm going to do is I'm going to shift my stop loss line from below here to over at our entry. Okay, so we do this in order to break even and protect our position. So if price continues to rise, that's great. We'll probably hit our take profit. But if it doesn't, which you can see in this case it didn't, we do want to be protected. Okay, so we got out of this losing trade at break even. Now, if we take a look at the next example, which is idea invalidation, it's kind of the same concept, but in this case, we are placing the idea invalidation level before the stop loss. Okay, but same thing, it's basically the level where you admit that you are wrong and you want to get out of the trade. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So in the previous example for break even, we moved our stop loss levels. For idea invalidation now we are getting out and just taking a bit of profit. Okay, let's take a look at this example. Our entry is here at this double swing high again. So I'm going in for a sell entry now in this case. Okay. So in this case, I am looking for a sell entry. So I'm moving downwards. Okay, I see price dropping towards our take profit, but instead of continuing, it reverses and it hits back towards our entry. So I can see my entry here. It actually breaks out of my entry and it hits upwards. Okay, it hits upwards and it triggers my idea invalidation level. Thankfully, instead of continuing to our stop loss, it reversed off of the idea invalidation. And then we admit we're wrong, and then we get out of the trade by moving our take profit to the entry. Okay. So if you're wondering, why is it that we can expect price to reverse off of this level? You know, like why won't price continue to rise? It definitely can, but the reason why we have this idea validation level is because, like we mentioned earlier, these significant levels of confluence, like swing highs, swing high resistances in this case, or like Fibonacci confluence areas, is because price is likely to reverse off of those levels. So that's why we can take the opportunity, see it reverse, and maybe see if it continues to our take profit. In this case, it didn't. So that's why we would place our take profit here. Okay? Okay. Okay, now that we've been taking a look at a lot of lot sizes because we're talking about the martingale strategy. So maybe let's touch a bit on leverage. Okay, so leverage in trading basically refers to the use of borrowed funds or margin to increase the potential return on investment. So in other words, it allows traders to control a large amount of assets with a relatively small amount of capital. Okay, so in the case of Forex, money is usually borrowed from a broker. Forex trading does offer high leverage in the sense that for an initial margin requirement, a trader can build up and control a huge amount of money. Okay, so that's one of the reasons also why martingale strategy is pretty popular for Forex since it offers a high leverage. Okay, but another danger, of course, is that if you lose your initial margin requirement or your initial margin, you would basically empty out your capital. Okay, so here's an example. So let's say you want to buy 1,000 shares of a stock that is trading at $10 per share. Okay, in this case, we're talking about stocks. In this example, we're using stocks, but similar idea can be used for the different currencies that you're using. Okay, so but you only have $5,000 in your trading account. So you use a leverage ratio of 2 to 1, and then you borrow an additional $5,000 from your broker, giving you total of $10,000 to buy the shares. So this means that if the stock increases by 10%, your return will be $1,000 or 20% of your original investment. So while leverage can amplify your profits, it also magnifies losses. So it's important to note that the use of leverage involves borrowing money and incurring interest charges and fees. And we kind of talked about this when we were introducing martingale strategy. Okay, so that's why it's crucial to understand the risk that's involved if you decide to use the martingale strategy or if you decide to use leverage. Okay, so again, a couple of examples. Capital of 10,000, just how we calculate the leverage. If it's 1 to 20, it would be 20 times 10,000, giving you a position of 200,000. 1 to 100 will give you $1 million, and 1 to 500 will then give you $5 million. Okay, and here's how we calculate profit. So, depending on your risk appetite, if we're looking at high risk, your lot size would maybe be 5 lots. So your total value of transaction would be 500,000. Okay, 10,000 times 500, 500,000, and then if you make a 100 pip profit, it'll be plus $5,000. So you gain 50% of your trading capital because you can see your initial capital is 10,000. So now I have made a 100 pip profit, giving me an additional $5,000. Okay, if we're talking about low risk, I'm just using one lot. 10,000, my total value of transaction, my initial capital is 10,000 with a lot size of 1. Total value of transaction is 100,000. So if with a 100 pip profit, I would be making $1,000, which is 10% of my initial capital. Okay. So we want to emphasize that it is a double-edged sword because obviously if you can make 50%, you can also lose 50%. Okay, so yeah, just be careful of that. And let's touch a bit on margin before we end off. So margin in trading refers to the amount of money that a trader needs to set aside in their trading account in order to open and maintain a leveraged position. So it's essentially a deposit of collateral that the trader is required to put up in order to cover any potential losses. So this is just how to calculate margin if you are curious. Most of the time, your whatever trading platform that you're using, it will calculate it for you. But yeah, a margin-based leverage basically equals to the total value of transaction divided by the margin that's required. Okay? So let's say, for example, if you're required to deposit 1% of the total transaction value as margin, and you intend to trade maybe one standard lot of $1 that would be equivalent to 100,000 USD, but the margin required is only $1,000. So your margin-based leverage will be 100 to 1. Okay, so for margin-based margin requirement of 0.25, you can see here your margin-based leverage would be 400 to 1, and it's using the same formula. Okay, leverage in the forex markets tends to be significantly larger than the 2 to 1 leverage that's provided on equities, and even the 15 to 1 leverage provided in the futures market. So although 100 to 1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during intraday trading. Again, this is why martingale strategy is really popular amongst scalpers who are trading forex. Okay, so traders should choose the level of leverage that makes them the most comfortable. If you're conservative and you don't like taking many risks, or you're still learning how to trade forex, a low level of leverage would maybe be better, like 5:1 or 10:1 might be more appropriate. So for more seasoned or risk-tolerant traders, then you might be comfortable with 50 to 1 or 100 to 1. Okay, so there are different types of traders as well. So martingale would probably suit more scalpers or intraday traders as compared to swing traders and people who prefer to just place your trades and then go about your day. Okay, this is just some examples from MT4. So the margin denotes the amount that's held by for the trades that are already open. So free margin, here I'm looking at this area, this gray area. Free margin denotes the amount of funds that is available to open new trades. Okay, so when equity sold balance plus minus open profit or loss, that's how you calculate your equity here. But you can see it's normally already calculated for you. So if that falls below 90% of the margin that's required for maintaining your positions, then you will probably get a margin call. Okay, so in that situation, you would then be required to deposit more cash to sustain your positions, or you might be forced to close your account. Okay, stop out. So margin denotes the amount held for the trades that are already open. Free margin falls below 50% of the margin required for maintaining your positions. Positions will be automatically closed in order for the largest losing position to be the smallest. Okay, and let me know if you guys have any questions, but that brings us to the end of our webinar. And yeah, let me know if you guys have any specific questions about martingale or anything like that. Okay, if there are no questions, yeah, you guys can leave. Thank you guys so much for joining me today. I hope you guys found this session helpful, and I'll see you guys next week. Bye, everyone. Have a great rest of your week.